Hi everyone, and welcome to the next section of the Personal Savings Options chapter. I'm so glad you're here and can't wait to start to break down the ins and outs of some of the accounts that really have the power to grow your wealth. To begin, I want to mention that the next two types of accounts are classified as registered accounts. That is, they are registered with the government, which is how the different benefits they provide, as we will come to see, are legal. Again, the two registered accounts we will be talking about are the TFSA and its US equivalent, the Roth IRA, and the RRSP and its US equivalent, the 401k/IRA. This lecture, we're going to focus on the TFSA and Roth IRA. So let's dive in. The TFSA stands for Tax-Free Savings Account, and the Roth IRA stands for the Roth Individual Retirement Account. I'm going to explain the TFSA since the Roth IRA is quite similar, but after we will look at the differences between them. So the TFSA was introduced in 2009 as a way for young Canadians to build their wealth starting at a young age. This is the only legal way that you can earn money and not pay taxes on that earned money. Just so you know, normally when we make an investment and it goes up, also known as it appreciates, you have to pay taxes on the money you make on that investment, known as capital gains tax. We'll go into detail in a later chapter about the amount of tax you have to pay on the money you make, but the important thing to realize is that the amount of money you have to pay is more than $0, whereas with these accounts, they are tax-free, so you don't pay any taxes on the money you make. Okay, so let's get back to the TFSA. While the account name implies that it is a savings account, its main benefit comes from its investing opportunities. The way it works is quite simple. As you earn an income, you are taxed on that income right on your paycheck, and the money at the end of your paycheck is what you really take home. Then, any money you put into your TFSA has already been taxed. In your TFSA, you can hold cash, mutual funds, stocks, and exchange-traded funds, and more. If you're unfamiliar with any of these, don't worry, they will all be covered in the next chapter. Now, if you earn any money through interest, dividends, or capital gains, i.e. the value of any investment you make increases in some way, you do not have to pay any taxes on them, provided that the gains were made in the TFSA. This means all of your investments will grow tax-free. Now you may be wondering, this is too good to be true. Why wouldn't I just put all of my money in the TFSA so I never have to pay taxes on my growing money? Well, the government thought of that too. There's actually a limit on how much you can contribute to your TFSA, and as of 2018, the maximum amount is $5,500 per year from 18 years old for life. So keep in mind that the contribution limit has changed in the past and it could be adjusted in the future. If you're already 18 or even older, don't worry, you haven't missed out yet. For any years that you have missed contributing to your TFSA, you can put in that amount. For example, if you only open a TFSA when you are 19, you are eligible to put in $11,000, $5,500 for when you're 18, and another $5,500 for when you're 19. However, if you over-contribute, there are fines and penalties, so make sure that you do not over-contribute to these accounts. Remember, the TFSA is the only mechanism of income where you do not have to pay taxes. This means you can grow your money much faster than in any other account. The reason for this is analogous to the example we showed with how debt eats into our returns. When we invest and make money, we get taxed on the money we make. This means the government takes a percentage of what we make. If we don't have to pay tax on our investments, then the amount we would have paid in taxes can be reinvested to make more money. Now, you should know that there are no penalties to withdrawing funds from your TFSA, but I highly recommend that you do not withdraw any money from this account. If you do withdraw money from the account, you can only pay the money back the following year, or you'll be penalized for over-contribution. For example, if you have already contributed the maximum amount of $5,500 to your TFSA for the current year, and then you withdraw $1,000 from your TFSA in 2018, the current year again, then you can only recontribute that $1,000 in 2019, the following year. So in 2019, you can contribute $6,500 in order to compensate for the $1,000 you withdrew in 2018. While this might seem like there is no harm done, the amount of money you could have made over the past year by investing that $1,000 tax-free is what you lose out on. This is commonly referred to as an opportunity cost. You did something that didn't cost you something immediately, but cost you an opportunity that would have made you money. Again, if we have done our financial planning correctly and we have our rainy day fund set up in our checking account, and if we really need it, we also have money in our savings account, which we have easy access to as well. So there's really no reason to be withdrawing money from our TFSA. Also, if you want to use this account to save up for a computer or a vacation, that would be a waste of the power of the TFSA. This account should only be contributed to, not withdrawn from. Funds for vacation and other large purchases should be accounted for and put into either your checking account or savings account. When it comes to putting money into these registered accounts, we really do not want to withdraw any money for as long as we can because of the opportunity cost associated with it, and because we don't want to feel under pressure to sell our investments. And we'll talk more about this point in the next chapter. The TFSA is an essential wealth building account. It should really be called the TFIA, a tax-free investing account. The big picture of the TFSA is that in 30 or 40 years' time, you may want to retire. This will be one of the two accounts that will help support your retired lifestyle, so we don't want to withdraw from it for as long as we can. Okay, so that covers the TFSA. And now you might be wondering, well, how does this compare to the Roth IRA? And there are really three key differences between the TFSA and Roth IRA. The first is that withdrawals of what you contribute are not taxable or penalized, but withdrawals of the earnings you make within the account are taxable, and you will pay a penalty of 10% on the earnings you withdrew unless you are over 59 and a half years of age and you've had the account open for at least 5 years. Okay, I know that was a mouthful, so let's look at a quick example here to make things a little more clear. For example, if you put in $1,000 into your Roth IRA, and in 1 year your investments appreciate by 10%, your $1,000 has turned into $1,100. If you take the money out of the account, you won't be taxed on the first $1,000 because that's what you originally contributed, but you will be taxed on the $100 you made, and you will pay a penalty of $100 times 10% equals $10. So you have to pay taxes on the earnings you make as well as that penalty of 10% on those earnings. Now, the reason the US government chose 59.5 as the cutoff limit for when you can withdraw with or without a penalty is to encourage people to save for retirement. There are some other exceptions as well, and I provided some links to some websites that do a good job of explaining nuances of the Roth IRA in the references doc for this chapter. So the second difference between the TFSA and the Roth IRA is that the contribution limits are not the same for both. The Roth IRA is actually income dependent, so depending on how much money you make every year, the amount you can actually contribute varies a little bit. It's roughly about $5,000 per year, but if you make over around $130,000 per year, then you cannot contribute to the Roth IRA. But don't worry, if you are making more than $130,000 per year, there is another option called the Roth IRA conversion. This topic is a bit more advanced and kind of outside the scope of what we're trying to cover, but for those interested, or for those of you making over $130,000 US dollars per year, I have an article that can be found in the references doc as well that will give you some more tips and tricks about how to handle this scenario. Finally, unlike the TFSA, with the Roth IRA, you cannot carry forward any time you missed contributing. So if you forget to put in $5,000 one year, you can't put in $10,000 the next year to make up for the $5,000 you missed in the previous year. This is a reason it is important to stay on top of how much money you put in each year into your Roth IRA, because you definitely do not want to miss out on putting $5,000 away, which can grow tax-free. And awesome, that's it. That covers these two very powerful registered accounts. I hope you enjoyed learning about the TFSA and Roth IRA accounts and really can see the value of how they can grow your wealth. Also, if you're interested in looking into more of the differences between the TFSA and Roth IRA, there are 2 more articles I've posted in the references doc that I have found quite helpful. So check those out when you get a chance. So I know this has been a ton of information here. I hope you've found it useful, and feel free to do your own research now that you have a better baseline for how the TFSA and Roth IRA work. There's a lot of different nuances, and depending on your scenario of how these different accounts work. So it's important that you actually look into the fine details, which is very dependent on your situation. But you definitely have the tools and knowledge in place to go out and do that. So I'm looking forward to seeing you in the next lecture where we discuss the RRSP and the 401k/IRA. All right, thanks again for listening and looking forward to seeing you in the next lecture.